So if you are a homeowner, I'm gonna make a case as to why if you have a 30-year mortgage, it's gonna get harder and harder and nearly impossible to ever pay it off in your lifetime. And this is even with if you have a 2.5%, 3%, 4% fixed rate mortgage. So just to give you a little backstory, I've had clients many years ago who've been homeowners for 20, 30 years. You know, they're in their 40s and 50s, empty nesters, really in the stage where they're preparing to retire and they're approaching their retirement age. But what was interesting and strange about this is that they've been homeowners for 20 plus years, yet they had 20, 25, 27 years left to go on their mortgage. So to me, the math didn't add up. Like, how were they homeowners for the last 20 years, yet they still have 25, 27 years left to go on their mortgage, and they're approaching retirement age fairly quickly. So the chief complaint with them in their 50s, they're seeing that their mortgage may potentially outlast them, and by the time they're actually done, they're gonna be closer to 75 or 80 years old when they're actually mortgage free. So I began to invest as to why this is a common phenomenon here in the United States, where someone who is a 40, 50, 60 years old, been homeowners for almost 20 years, yet they still have 25 years left to go on their mortgage. So let me show you why this is happening and why this could be happening to you and why you might not ever be able to pay off your mortgage ever. Okay, so we first have to start out with how does a mortgage get paid down and what is the process like in the first place, because this does set the stage for what I'm about to share. So what you're looking at on the screen is something called an amortization graph. And this basically depicts how your mortgage payment is used to pay down your loan for the next 30 years. So when you look at the line that goes left to right, this ultimately represents the amount of time you spend in paying down your mortgage. So for most of you, you have a 30-year mortgage. This will be the 0-year mark here, and over here will be your 30-year mark on the right. The line that goes up and down, the vertical line, represents your monthly payment. Now, in this chart, the vertical line is represented by a percentage. So for example, let's say your monthly mortgage payment is $1,000, excluding your real estate taxes, as well as your insurance escrow. So your $1,000 payment is actually made up of two parts. It's principal and interest. The principal portion of your payment is actually going towards paying down the balance of your mortgage, whereas the interest is going towards, well, the fee or the financing cost of borrowing that money from the bank. And here on this graph, it's depicted with interest being the lime green color and principal is depicted as orange shaded area. And over the 30 years, a specific portion of your $1,000 payment is going towards principal versus interest. Now, you'll notice in the first let's say about 5 to 10 years of your mortgage, vast majority of your monthly payment, $1,000 in this example, is going towards interest. Now, what you'll notice is that in the very first payment in this example, about 30% of your $1,000 is actually going towards principal, which we talked about how that actually makes an impact on the mortgage balance. So only a small portion, a 30% of your $1,000 monthly payment, which will be $300, is going towards reducing the principal balance, whereas the $700 is actually going towards interest. And so this happens typically within the first 5 to 10 years of your mortgage. And the closer you get to the center or towards the later part of the mortgage, more and more of your payment is actually going towards the principal. Now, it's designed this way as far as paying down your mortgage because really the first 5 to 10 years, the principal balance is at its highest. As you pay down that balance, less interest is accrued on that balance. Now, here's where I'm gonna explain why even if you've been a homeowner for the last 20 plus years, you still have 20, 25, 30 years left to go on your mortgage when your mortgage is only 30 years. So if you've been a homeowner for 20 years and you have a 30-year mortgage, technically you should have 10 years left to go. But why is it that a lot of homeowners, it's common for them to still have 20, 25, 30 years left to go? Here's why. Now on this graph, I'm gonna draw a line around the 6 to 7 year mark, and there's a very specific reason as to why. Now, according to the US Census Bureau data, this is 2007 ACS data, the average US adult moves about 11.7 times in their lifetime. Now, this could be due to various reasons. Maybe you have a different job offering across town. Maybe you move out of the state. Maybe you end up having a larger family, so you need a larger home. Maybe you downsize because you're now an empty nester. There's several reasons as to why you might end up moving. There's plethora of reasons as to why you might end up moving. And this is where we begin to see how that might play a role with the mortgage. If we are indeed moving 11.7 times in our lifetime, and let's say we live to be about 80 years old, well, that's roughly every 6 to 7 years. If our assumption is taking 80 years divided by 11.7, we'll usually get about that 6 to 7 year mark. So you can see why I drew a line on that 6 to 7 year mark, because that's typically when most Americans, average adults here, would decide to move for various reasons. And some of you at this point might be understanding what I'm alluding to. If you, as the homeowner, made it to that 6 to 7 year mark and you had to move because of a job, a career, you decide to move out of the state, well, over the last 6 to 7 years, you've been paying mostly interest as indicated by this amortization graph. Now, if you choose to sell your current home, move to a brand new house, get a brand new mortgage, what happens to the amortization graph? Do you get to continue making the payments, progressing towards where you're actually paying down principal? Or do you have to start all over back to square one? Well, if you answered start back to square one, you are absolutely correct. You have to get a brand new 30-year mortgage because you had to move because of a life circumstance. You have to start all over where your new monthly payment on your new mortgage is going back to a spot where vast majority of your payment is going yet again to interest. Never mind the fact that you've been paying down your mortgage for the last 6 to 7 years on your previous mortgage. Now you're having to deal with a new 30-year mortgage. Now you just further delayed and kicked the can down the road for another 30 years of your life. And if you're one of those homeowners that have a 2.5%, 3%, 4% mortgage, the question for you is that, are you guaranteed to stay in your current home for the rest of your life? If you are, and you have 100% guarantee that you'll stick with that same house, awesome, then you're pretty much set to go. But there's no guarantees in life that you'll stay in your current home for the rest of your life. And just like what I'm illustrating here with the US Census Bureau data, there's a good possibility that you could end up moving in the next 5 to 10 years, especially if you refinanced or bought a home in 2020 with really low rates. In about 2-3 years, you may have to face a decision to sell your house because of an unforeseeable life circumstance. So ultimately, here's what that could mean as far as your interest costs and why you may never be able to pay off your mortgage ever in your lifetime. So I made a little spreadsheet to calculate the true cost of your interest if you do end up moving every 6 to 7 years. So let's just say in your first or your current mortgage right now, you bought a home or you refinanced back in 2021 where rates were incredibly low. I mean, 2.5%, 3%. I know a lot of you took advantage of that. So let's say back in 2021, you refinanced or bought a new home, principal balance of $250,000. And if we're anticipating that you would move 6 to 7 years, which would be about 2028, you would have paid down about $40,573 and about $49,000 of interest in the first 7 years of that mortgage. But because of a life circumstance, you had to move because of a new job. Let's say you had to get a brand new loan in 2028 because you've moved, and expecting that or assuming that real estate prices could continue to go up. Let's say your principal balance increases because you had to get a larger loan for that bigger house. So in this scenario, $350,000 principal that we borrowed, we pay down only $39,706 because we can anticipate the rates could be higher in the future, probably around 5.5% to 6%, which is my opinion. And here's where you might cringe a little bit. In this 5.5% loan, in the first 7 years, we're illustrating that you're paying $129,000 of interest and pay down only $39,000 of principal because of the 5.5% interest. Again, this is just an illustration to show and assume that you're gonna go and borrow this loan in 2028 and expect to move again in 2035. So in that 7-year time period on loan number 2, we're paying $129,000 of interest, pay down only $39,000 because of the amortization on the mortgage. So you can see that the 3% mortgage you had in loan number 1 isn't really helping you in the long term. So to continue in 2035, if you were to move again, assuming for the illustration purposes, we get a new mortgage at $450,000. We pay down $51,000, keeping the rate about the same because it's really hard to tell what the rates will be in about 20 years. We're calculating $166,127 of total interest. And again, if you want to see the math, I put together an amortization schedule for each of these loans and just factoring out where is the 7-year mark for each of these 3 loans. So that's how I did the math on that. And if you're curious, I'd be more than happy to give away this spreadsheet for free. Now, if you notice in the total column, we pay down $131,000 worth of principal. Okay, we're not counting any appreciation or anything like that. But because we hopped around in 3 different mortgages since 2021 to 2042, we paid a total interest of $344,000 approximately across all 3 loans. And that again has to do with the fact that in the first 5 to 10 years of your mortgage amortization, vast majority of your payments is going towards interest. So sadly, this is the reality for many homeowners here in the United States who've been homeowners for 20 plus years. You know, they're in their 40s, 50s, or even 60s, yet they still have 22, 25, 30 years left to go on their mortgage, but mostly because of the shift in the socioeconomic behavior where more and more Americans today are mobile, they're moving, we're having to change jobs. I think on average, the average person shifts or changes 7 careers in their lifetime. I don't have the exact data on that, but it's very frequent and it's becoming more common to change jobs and to change locations than ever before in the history of the United States. And so for many of you watching, you might be in this situation right now where you're in the 40s, 50s, and 60s, and you have long ways to go in paying down your mortgage, let alone your mortgage payments might be delaying or even dragging your retirement goals down. And that might be the concern you have as far as why this even matters to you. So you might be asking, okay, Sam, what is a good way to pay down your mortgage faster? Is there a way out of this? Is there a remedy to this trap? Because I'm in my 40s, I'm in my 50s, I'm in my 60s, and you're right, Sam, I have 25, 28 years left to go, and I can't afford to have my mortgage outlast me because I have other better things to do, like retire. If you are in this situation, I have a separate video on how to pay off your mortgage in as early as 5 to 7 years. I'll leave that link down below in the video description, or I'll even pin it in the comment section so that it's easier for you to find. And in that video, I'm gonna explain a method and a strategy that's being used by thousands of homeowners right now in paying off their mortgage faster. And as a caveat, it may or may not work for everybody, but if it does, it could be a very powerful tool to be able to help you pay off your mortgage faster and to ultimately help accelerate towards taking better control of your finances and feeling confident about your future retirement goals that you have. So with that being said, I'll leave that video down below if you're interested. So if this isn't necessarily for you, but you have family members that may want to hear this, go and share this video with them because I think this is going to help them a lot in just bringing awareness to the problem that I think a lot of homeowners have right now and why I believe that a lot of people, unfortunately, and very sad that they're gonna die with their mortgage and probably won't ever be able to pay off their mortgage. So with that being said, I hope this video gave you some epiphanies and realizations. And if you thought this was valuable, please leave your thoughts down below, like and subscribe, and follow us for more financial tips here in our channel. If you do that, that'd be greatly appreciated, and we'll see you in the next video.